Well, I think, folks, we'll get going if we can. We've had three really fascinating presentations, really got my mind thinking, and they were quite varied, which I thought was interesting. So Susan kicked off with very much kind of the ethics of banking, what's being done in the long term to improve the people. I loved, Anthony, your bit about the blacked out mandate. That really excited me. I missed, by the way, why did you have 28 years? What was the...
I have an affinity with 2042 because that was when my first driving license was due to expire.
Okay, so the driving license expiry lecture, we'll call that one. And then Paul, I just love somebody who can say that Eugene Fama and all that crowd, frankly, have got it wrong, and everybody else for so long. So this has been really, really exciting for me. What we're going to do is have a bit of a discussion. Those of you who've been here before might remember. We will start with a few remarks, initially by Kelly, who's joining us up here, to give a reaction from a long-term view. And so do look up Kelly's bio in the pack. I won't try and read it. And then I'm going to ask each of the speakers to make a short comment, very short, a minute or so. And then we'll turn over to you. There are microphones in the audience, Chloe and, Triz, thank you very much, both of you. And if you would, please take the microphone, identify yourself, any affiliation you wish to make known, and then if you could, get to the point. We don't want some microphone hogging. And I'll take those probably in threes or fours. The quicker you are, the more other people get to make their comments, and we get the tenor of the audience. And then I'll turn to the panelists who are not going to answer the questions exhaustively. They'll pick up anything that they like and talk back to that. So that's kind of the format for the next hour. And I guess if there's a little bit that I'd just like to kind of pull your comments towards, it's this paradox between long and measurement. And I thought all three speakers touched on that. Susan in her parallel universes, Anthony talking, very much about how do you try and find, what your phrase was sort of new prisms for looking at that. And Paul, who was pointing out, I think very, very clearly that the more you try and do index-type benchmarking, the more likely you are to increase bias towards the short term. So I think all three of those are very good. But Kelly, would you like to just kind of give us a reaction? How did you find all of this?
Absolutely. I'm just going to give some of my highlight insights and then kick it over to the panel. I was really struck when Susan talked to us about the core purpose of markets and the real need to get trust back into the way in which markets are perceived. And I think that a measurement system that's fit for purpose, but also fundamentally functional for what it sets out to do, is something that fed across all of the presentations in my mind. And I really liked the example of the shopping mall in the Bronx, because that was a story of engagement. And very often in looking at measurement and certainly returns, as investors and as people that are beneficiaries of pension funds, we don't necessarily put as much attention on the engagement part of things in terms of returns. So I thought that was really a great way to kick off. The other point about the delivery of what the customer wants is absolutely crucial, but in order for the customer to be able to express that demand, they must be financially literate and actually have a way into understanding what's being sold to them. And that is both relevant on the measurement side, but also in terms of communications. And that part I felt was very important, and it plays out in benchmarks as well, which I'll come to in a moment. I'm very happy to hear about the Chartered Banker Professional Standards Board as an individual and as an industry standard. And then I guess my question is, to raise the bar and perhaps even provoke a bit, is where do we get a standards board about systemic risk, and where does that come in at a board level? Because I think very often the individual doesn't know what kind of systemic risk is prevalent within a bank or financial system, and that too plays out in long finance concerns. That's an operating systems concern. Anthony, I was very struck by your graphs and the raw reality of trying to reconcile our systemic bias towards short-term events with the empirical data that clearly demonstrates intrinsic value manifests over the long term. And that is a trillion-dollar question. And then following up, rounding out my comments, benchmarks have long been a real bugbear for me because, and this is a provocative comment, I'm sure, but I think benchmarks are very often used as a lowest common denominator, or really just a reversion to the mean in some of the, certainly in some of the beta investments that we see. So to see that depiction of how we actually, certainly in my own view, the risk of a benchmark and some of the high risk versus low risk perceptions are absolutely wrong was absolutely enlightening. And then lastly, I was just struck by the simplicity of the fact that if we do reduce turnover, we lend ourselves to a much longer term thinking and therefore potentially much higher return environment. So that's where I stop, and I thank you all.
Wow, that's an excellent summary, Kelly. Thanks. I mean, just on the discussion point of kind of the paradox between long and measurement, how did the earlier discussions develop your thinking on that?
I guess, again, I think that we don't necessarily have the best tools at play. And I think that long and measurement is so much a matter of what is fit for purpose and what the core banking goals are. If we're looking at people and planet, where does fiduciary duty and returns fit into that within the context of measurement? So my thinking is evolving, and I'm sure it will much more as we go on.
Susan, you had a great phrase I liked for long finance, beyond identifiable numbers. That was very, very good. But how did you react to the other two speakers' presentations?
Well, I mean, I was very, very interested. I said to Paul as we came up, a real reminder that we all operate to conventional wisdom. You know, we grow up and everybody says this is the way it is, and so that's the way it is, and we don't pause and actually question, is it really the way it is? Where's the evidence? I'm a big, very much in favor of evidence, of actually understanding. And when we talk about evidence to understand points, I also think you can gather lots of data points, so you've got a big picture, but you actually then lose the refinement of either end. So I think you need to see it all pulled together, and then you need to see it on the ends as well, to see what's peculiar. But I mean, that's really what that said to me. I thought it was a very, very compelling message.
And Anthony, Keynes is in the long-term world dead. You're predicting nuclear proliferation and complete destruction by Crimea and South Korea by the end of the year, was that? Is it?
That wasn't forecast.
What did you think about what Susan and Paul had to say?
The one thing that arose in both of them was proposals for standards and how we might lay out a framework for people to operate in different manners. I guess standards are obviously an excellent starting point. And I suppose this is my biologist background coming through, but we've evolved as self-interest organisms, and the standards obviously have to play directly to the self-interest of the participants too for them to get traction. So I'm interested in thinking of the aspects on both sets of proposals that are nice for society, that's great, but also in the interest of the participants that they're directing.
And Paul, you put up the VW theory, which I think is to be contrasted with the Audi theory. But for those of you who didn't quite catch that, that's the Vianus-Willi theory, I believe. I was particularly interested in your bit where you're talking about there's been this huge proliferation, not nuclear, of passive benchmarks and indices, and clearly under your scenario, that's horrifically dangerous. But you were also. You also spoke about, why isn't there sort of a new contrarian who's taking advantage of that? And then I moved on to one thought I wouldn't mind you expanding on, which is that, is this because the agents, the investment managers, the asset managers who've been active have got such terrible records? So I sit there and I say, well, they clearly don't know what they're doing, so I will go passive. And what can be done to break that as much as reducing the turnover rates?
That's a big question. I'll be as brief as I can. The size of the asset management industry, indeed the size of finance itself, is testimony to its failure, to its malfunction. Finance is the biggest and most highly paid industry globally, and particularly in this country, representing 8% of GDP and actually a good deal more, a higher percentage of the free market GDP, GDP ex-government. The academic theory, I keep coming back to the starting point, which is the academic theory. I mean, can I just interpose this? I don't actually blame bankers. I blame the academics. And they've got away more or less scot-free, and it's disgrace. In finance, in conventional theory, if you're making money, people are buying something, and therefore they think, the idea is in academic finance that if something's bought, it's conferring utility or benefit on the purchaser. But it doesn't work like that in finance. As I said, contrasting with a washing machine, we're all marching to the wrong theory and understanding of how finance works, and that is the disaster. And so the finance sector is bloated, it's exploitative, and it's crisis-prone. And it spells the ends of capitalism if we have another crisis or so after this. I mean, we've had enough convulsions, and they're continuing convulsions. If we don't quickly address some of the measures of... The key thing is how capital is invested, and what is needed is a code of best practice promulgated by a multinational agency for trustees, for corporate issuers, for fund managers, and for policymakers, based on a better understanding of how finance works. Sorry, what was the question?
Well, let's get some questions from the audience then, if we could. Could I have some hands up here for people who'd like to have comments or questions? So, Clay, we'll start up here. We'll start with Raj, and then we'll move over here, and then this gentleman there. So let's go with that.
It was a superb set of presentations, and all...
and you are?
Raj Samostram, CEO of Preventable Surprises. Superb set of presentations, all complimentary. I came from a meeting just this morning on long-termism, where Dominic Barton from McKinsey was speaking. He's partnering with CPPIB. And one of the key points that came out of that meeting was that there is an ongoing lack of conviction on the part of even the people who came to the meeting that there is a performance benefit to be had from taking a long-term approach. There's still that sense of, give me the data. And I'm kind of comparing that with Paul's exquisite dissection of the kind of problem with the current business as usual, where there's all the data that we have that we need about the failure of business as usual, but no one seems to be worried about that data. So I'm kind of wondering, where does data actually come into play here? Is this just another behavioral bias that we look for the data that validates what we want? And then I was also very interested in Susan's strong personal conviction about standards and what we need to do as professionals. And I'm looking at how the CFA, which is the key body in this area, propagates actually dysfunctional thinking. But it has this kind of bolt-on project called the Future of Finance, which is very exciting, and John Kay and many other good people there. But it's definitely bolt-on. And I'm wondering if the heads of the CFA, and I'm sure there may be some here, were in this room, what would, Susan, you tell them, and what would we tell them about what CFA needs to do, which is a little bit more ambitious?
Thank you. Chloe, just gentleman here.
Adrian Kempton-Cumber, I'm a private investor. I'm always looking for differentials between the market and whatever I'm trying to invest in, either way. I don't care if it's long or short. So I analysed all of the companies in the S&P 500 that I could find that were on lists of ethical companies, and what I discovered was that there was no alpha to be made. They actually literally tracked the market. Given that, I suppose the one question is, why aren't all the other companies trying to be ethical as well, since it obviously doesn't cost anything? But then why would anyone invest in ethical companies then if there's actually no financial advantage apart from the obvious humanitarian reasons?
Thank you. Gentleman in the middle.
Yes, I have no problem with capitalism and the financial system that we have. I think it's always been very good, and I think it still is. And in fact, tonight, this conference shows me that it is still going very well. But the problem, of course, is political. chucking industry's capital down welfare's bottomless pit is bound to create an industrial crash. And there are two fudges you can make. Firstly is by printing money, and of course that creates inflation, so that's a no-no. But the other is, of course, borrowing money from the sheiks of oil sheiks. And of course, the question then is, in the long term, when are they going to ask for their money back?
Okay, thank you. Therese, there's somebody just to your right.
Thanks. Ian Potts, ex-trustee of a pension fund now and a SIP investor myself. We've been talking about long-term, but nobody's actually defined what we mean by long-term. After all, as we've been told, in the long-term we'll all be dead. But equally in the short-term we're all going to lose money. How far do we look for this long-term?
And actually, Chloe, we'll tell you what, we'll take a couple more than just this gentleman here, and then the last one will be Brandon up here.
You haven't described how to measure return and risk. You haven't described whether it's possible to evaluate them in a stable manner between different periods. So it seems to me that until you define methods to measure these things, there is no way you can derive conclusions from the data.
Okay. And finally, Brandon up here. Again, please identify who you are and any affiliation.
Brandon Davies, I'm chairman of a private equity company. It really follows on from the last comment that's made. This is all about measurement, but it strikes me that the fundamental problem is one of definition. None of you have really offered a convincing single definition, either of risk or indeed of value. Value strikes me as one that economists have been chasing for a good 300 years and never managed to agree on. And risk seems to be something that I certainly had a lot to do with implementing in UK dealing rooms. We defined it the way we did simply because it was the only way we could measure it. All the other definitions of risk, which we thought were far better than the measure that we went for, were ones that we couldn't possibly metric. And so we got to it by measuring rather than defining. That, I think, was a fundamental mistake. But on the other hand, if you can't define these things, it strikes me that wishing to measure them is a complete waste of time because you're never going to get to a measure. And indeed, what that does is throw much more emphasis on conduct and the way people behave, because you can't measure good behaviour, because you can't define the components of it. So you end up saying, well, how do people behave? And I think one of you said tantamount to the opposite of that, which is that we have to take action in the short term. Well, actually, that's exactly the problem I think we get ourselves into.
Thank you very much. Well, we've got quite a few there. So what would you say to the CFAs? What's the ethical coupon, effectively? Nature of capitalism, definitions of long-term, definitions of return, definitions of risk. And an interesting circle is our very imprecision about some of these terms, a justification for having codes of conduct. I think, if I could, Susan, I'll start with you and then turn to the other two in order.
Okay, I'm not sure I'll answer all of those, but just a couple of thoughts that I had regarding the CFA. I know them, but not hugely well, but I have had conversations with them in the development of the professional standards work that we've been doing. And so I wouldn't sit here and critique them, but what I would say is that there are a lot of institutes, and they are that kind of body, which make judgments and which certify, if you will, those who work in that particular industry. And I think they do a good job, and they do this beyond the walls of the UK and so forth. And it isn't, I guess, to my mind, just about qualifying, taking the exams, and understanding what is a very complex world. I mean, you know, this is the CFA deals with people who, this is not a simple thing to understand. And people will be struck from the list, to use a better term, if they mess up, to use a piece of jargon. But there's something in all of this that I think institutes like them can do, which is the positive side. I believe in sticks and carrots. I think as a banker, we need regulation. We need to be constrained. We need to be told where the parameters are. You can't go beyond those parameters. But we need something, because this is human behavior and human psychology, that draws us in the right direction as well. It doesn't just make us avoid. And I say that because, and I've often said this, I'm not sure any of us has ever really grown up. So, you know, you give me a rule, and my first instinct is, how do I get around it? I mean, it really is. And then I have to kind of convince myself intellectually there's a reason for this rule and this constraint. So it isn't just about hemming the industry or individuals in. It's actually about finding ways to lure them and attract them to do the right thing in the right way. So that's one comment. The other thing, I would say, an interesting question about ethical companies tracking well and so forth. I guess I sit here and think, we always talk about the ethical companies, and then there were those others. Why are we bifurcating? We need to get past that either or, because that's where you get into these two universes. You know, things happen here and they're different over there. One place where I do think I see some difference is in companies that are run in a partnership model. So, you know, small ones and big ones, where everybody has some kind of ownership in the company, and I see different reactions to decisions and more generous reactions for the good of the company and less selfish reactions in those types. So there may be something about the style of company and the style of remuneration that comes out of them. So I'll maybe stop there. So.
Well, I like the fact that mentally you're a computer hacker, which is great news. Anthony, your thoughts?
I never thought I'd hear a banker say banking needs regulation. So what I thought was interesting in a few of those questions is how the answer changes depending on your context. So we heard at the meeting this morning, people didn't believe that long-termism pays. And that may well be true depending on your reference frame. So one of the distinctions that we put emphasis on in the way that we operate at GMO is trying to ensure that our team doesn't feel that they suffer career risk from taking long-term decisions. So it may well be that the correct course of action to optimize your professional position is to minimize your career risk and behave for the short term. That there's obviously a conflict there between the different parties operating. There's another question asking us to define what long-term means. I think the common definition in fund management is that long-term is however long it takes for one's positions to come good. 10 years, 20 years, long-term. Certainly not the sort of rhythm that most of fund management reporting cycles operate on, which are quarterly or 6-monthly. And then there's a question of risk, and I think the observation there was that your perception of risk is context dependent. I mean, from an asset management perspective, we've, for convenience reasons, come up with volatility-related definitions of risk that are not really fit for purpose. Perhaps as a long-term investor, the best shot at defining risk, or the most important risk that you care about, is the risk of the permanent impairment of your capital. That's the only really important risk if you're a long-term investor. But quantifying that risk is, there's no clean definition of the extent of that risk, and I suppose it's fair to say that much of the industry spends much of its time thinking about ways to get at it without ever coming out with a clean quantification.
So I liked your investment coming right, which I think is, when Paul mentioned that you've bought things on the cheap, it's just that they got cheaper. That explained quite a few of my investments. But Paul, your thoughts on some of these comments?
Yes, let me address some of the comments in the context of the CFA, the Chartered Financial Analysts Institute. It teaches, I don't know how many tens of thousands a year take the exams, but they're all over the world, the people both with CFA qualification. It's, I think, 3 years part-time. It's quite rigorous. I always asked my team to get the qualification if they could. It's being taken by more Chinese now than I think by Americans. I mean, it's global. They teach the prevailing paradigm because there's nothing actually else to teach. They teach that markets are efficient. They teach capital market theory, which is predicated on the efficiency of markets. The conventional wisdom is being handed down every day. At LSE, we teach the efficiency of markets. You don't swap a theory for another theory until its tires have been well and truly kicked and tested. One of the early challenges of Eugene Fama and his colleagues in Chicago in the 70s, one of the challenges, or alternative theories or exceptions, if you like, explaining the exceptions, were the behavioral finance academics, those people who explained mispricings or distortions of prices on the basis of the behavior of investors, that investors suffered from behavioral biases, psychological biases, which caused them to invest in a way that wasn't based on just simply a forecast of the fundamental cash flows. There was a behavioral problem. The first papers in behavioralism came in 25 years ago, have earned several Nobel Prizes, but haven't given rise to a single policy prescription. Because if you assume people are stupid, you don't have a scientific theory, period. So that's why I've been adamant that everything we do at LSE and indeed at Toulouse, which is also a center where we're doing this work, is that everything is conducted in a rational framework. Rational comes with baggage. What we mean by rational is that people seek to maximize their expected return and subject to risk, simply that. There may be lots of people not doing that, but the point is, can you explain distortions by assuming that people are indeed rational in the sense of they're profit maximizers, subject to risk? And the only step we've taken beyond what is done in the conventional theory is to introduce the process of delegation, simply that. And that was because in the tech bubble I observed that we as fund managers were being rational and optimal in sticking to a value approach. The customers thought we'd lost our marbles and it was a new world and therefore fired us. And they were perfectly rational. After 2 years of underperformance, they were quite right to fire us in their book. But so rational behavior by market participants, all market participants, could give rise to mayhem in markets, which was what we saw. The CFA, okay, they're not going to switch horses quite rightly, and academic tens of thousands of finance academics aren't going to change the way they teach. They will start to qualify it based on people presenting good work, empirically tested. I would actually say that would be 25 years of empirical testing with no theory, but okay, we'll skip that one.
Paul, you mentioned that both at LSE and Toulouse you're looking at return over risk. Could you just tackle the definition of risk for the audience?
Yes, risk is for want of anything better, is the variability of the return. So a return, you have the return each year, and you have the variability of that return within sub-periods, whether it's quarterly or monthly or whatever. And the trouble is, it's the obsession with the short-term risk that is causing all the problems with short-termism. Short-termism, to address somebody's question, is you haven't defined it. Well, it isn't the length. Let me emphasize that it isn't how long you hold an asset. It's what strategy you use to manage your money. It isn't the question of what's your holding period, although that helps to inform you. actually. But the crux of it is, are you simply following trends to minimize risk or make short-term gain, or are you using fundamental value? I mean, what we show is that trying to maximize your return each year is a good recipe for underperforming in the long run.
Kelly, did you want to comment on the ethical points, either Susan or comment there?
I completely agree that a bifurcation between ethical and non-ethical companies is ridiculous, because in doing that, we sanction non-ethical, or at least we make an indication that if something is ethical and everything is everything else, then that means that everything else is less than a standard that is actually serving people and planet, which that is a really big question if that's what we're doing. And you also have the same kind of debate coming up with sustainability. And actually, if I might, I just want to comment on Raj's point as well, because to me, your meeting this morning about does long-term pay. In the work that I do, and I should really let you all know that I spend a lot of my time looking at capital market reform as it plays out in terms of some of the risks of climate change. So that is my lens. But one of the things that comes up again and again and again is that externalities and material risk are not perceived as being a financial risk in a short enough time frame to be relevant to most asset managers. And so I wonder, going back to your question, if we think about material risk within a context of beyond 3 years or beyond 7 years, if all of a sudden long-term does pay, because we know increasingly some of the evidence of potential stranding of assets or permanent impairment are becoming a major issue, certainly a debate in this room, I'm sure. So that really struck me there is, does it pay? Well, the context is material risk and the time frame, at least the way I heard the question.
Let's have a few more comments and questions. Can I see some hands? Okay, we've got gentlemen. Chloe, to your right, Chloe. Just over there. 1, 2, and then there were 2 in the middle.
Sorry.
Right.
Mark Partington, carrying on from the comment whether people are stupid or rational, I'd like to hear the panel's thoughts on the government's changes to pensions and getting rid of a long-term asset, namely an annuity, and swapping it with rational or totally irrational decisions made by individuals who are either clever or stupid.
Thank you, Mark. There were 2 over here. Chloe, just these 2. And then we'll switch back to there.
Thank you. Peter Rowan from Ados Holdings. With regards to the acquisition and cultivation of your human capital to help you achieve long-term finance and investment objectives, I'd just be very interested to speak to or get the viewpoints of the panelists on how they go about it in cultivating that team to achieve those objectives, and what their selection process is, and if there is some sort of art or science to it that you think you've evolved. Thank you.
Mike Clark, various affiliations, so let me speak personally and therefore freely. Picking up a point about value, to the extent that we are seeking to measure something, to the extent the panel believes that we're trying to measure the creation of long-term value, the creation of wealth, could the panelists describe their personal perspective of what that process looks like? Because I think we're talking about the creation of wealth, the sharing of it with the investors, but also with other stakeholders. So maybe trying to paint a picture that becomes common parlance of what it is we're trying to measure might be helpful.
Thank you. And then, Chloe, I'm probably going to shift you back to the 2 gentlemen here in the middle. Can you see them?
Hi. The name's Nigel White. Amongst other things, I'm a trustee director of a pension scheme. My question, I guess, is really to Paul Woolley. I was interested to hear your hypothesis that capital asset pricing model is bust. I remember sort of looking at that in great detail when I did a business course many years ago. My question is, in terms of the evidence, well, it's bust, and the reason it's bust is benchmark setting. Is it the case, in your view, that that is across all asset classes in terms of pricing of all assets, or is it a phenomenon which is purely restricted to equities?
Okay. And just to your gentleman, just to your left. Thank you. Good.
James Bridgman, I'm a branding consultant. Given that recent discussions have intimated that we'll all be dead soon in terms of long finance, what does the panel think about the next generations of coming along in terms of education and how we can shape their approach to some of these issues in terms of the next generations of entrepreneurs and value creators and how they should think about some of these issues?
Okay. And Therese, to your right, there was a gentleman back there. You had your hand up at the back, if you could raise it. Thank you.
Gary Hoffman here. I'm wondering if benchmarking might have a future use in projection of risk, and whether were benchmark measurements available during Nick Leeson's tenure, if we might have avoided that disaster.
Okay. Well, that's quite a few bits. We'd like to talk about pensions, and are we going to be smarter now that we're managing our own objectives? Really on kind of what's our panel's vision on the creation and shape of future wealth, benchmarking against various asset classes, next generation on education, etc. Why don't I just shake it up a little bit and take it in reverse order? Kelly, do you want to?
Sure. I'm going to pick up on the next generations or future generations comment and a bit about the morbidity in the room. We're all going to die. I'd say that it's quite interesting context within long finance, because we are all going to die, of course. I'll take that point first, but we're all going to live a lot longer than we may have provisioned for in terms of our pensions and our savings, or at least than previous generations have. So that's something that makes this conversation extremely relevant. And I don't think we've really touched yet on how that money is going to last for longer. But in terms of the next generation, I think that this context is a fascinating one, because a lot of the standards that we all kind of hold to be true now, like banking and pensions, may not necessarily be relevant at all for the millennials. We're looking at alternative finance, we're looking at crowdfunding, we're looking at different ways of looking at money and savings and wealth creation. So I think that what we're in line for is quite a lot of innovation there, and how that relates to current context and long finance, I think, is absolutely yet to be determined. But I know that certainly amongst the 18 to 30-year-olds that I talk to, there's a real sense of being somewhat pushed out of the system, and therefore alternative forms of savings and finance is much more relevant to that group than it may be for some of us in older generations.
Well, there's a specific point about the asset classes, but also on some of the others.
Yeah. Let me talk about Warren Buffett and Jane Austen. Jane Austen actually should have been on this panel, because she always assessed the wealth of a suitor on the basis of not of his mark-to-market value of his property and estate, but actually in his annual income. I mean, income matters, and that's why we invest. We are investing for the long-term cash flows that come from the estates, the investments. And that's what Warren Buffett does. Value is trying to get at the long-term cash flows. You might not, the man in the street won't be agonizing what BT is going to earn in 10 years' time, but you don't actually need to go into great detail. There are a few basic measures. I won't go through it now, but the relationship between share price and net assets, or between share price and current earnings, or even next year's earnings. There are a lot of shorthand ways of getting at it. It's actually, you can use a fairly blunt instrument to exercise the value strategy, but momentum, you can't use a blunt instrument. You either win or you lose, and you're more likely to lose by buying and selling at the wrong time, because you're ignoring fundamental value. Is CAPM bust, and does it? Well, it is. It isn't very clever if it actually predicts the exact opposite of what we observe. I mean, it wasn't a very good starting point for the theory that there was plenty of evidence that the reverse was true. Does it apply? Yes, it applies not just to what I was saying, apply that high-risk securities deliver a low return. It applies also to asset classes. It's slightly more complicated, but the basic principles are still there. And we got into the business of, in the 80s, of pension funds moving into equities, because the next chap was moving to equities. The benchmark kept going up, and everybody wanted to be overweight equities. And so we ended up with equities representing 95% of the average pension fund. And then we had a crash. Well, no surprise, in '87. So yes, it does. What I said does apply to asset classes as well as, and indeed bonds as well as individual sectors or individual stocks. Rational and irrational. Let me just say that. Tim Hartford in the FT on Saturday, it was a nice piece. He said, or he quoted actually somebody saying, it's no good having 1,000 theories to explain 1,000 distortions. What you want is a unified body of theory that explains mispricing, period.
Yeah, so picking up on one or two of the questions. With regards to are we all stupid? Whether the government's right to unshackle pensioners on retirement. I don't want to profess a view on stupidity, but it does seem dangerous to create a situation where you with means testing certain benefits in retirement, you potentially create a dangerous situation where there is an incentive to behave, to fritter some of your savings in order to optimize what you can extract from the state. That does seem somewhat irrational. In terms of the question of wealth creation and whether we have a definition of or a description of that process, I mean, ultimately I think all wealth-creating processes can be simplified to some form of allocation of capital. And Michael started with the comment that if you measure, you manage. Part of the problem that I think has come up in various aspects of the discussion today is that if you measure, you can constrain behavior and affect behavior too, not necessarily in a good way. Sometimes not measuring is the best thing to do.
Just some odd comments. Several sort of comments around what is long term. I can remember years and years ago, an investment advisor said, well, you just invest in some shares and you just leave them. Don't trade, don't play around, just leave them. And here's a graph, and it was a graph over several decades. And look, the value of the stock market overall has always gone up. And all these shares were in there. But actually what happened is the companies that had gone down, a lot of them had gone all the way down, and they weren't in the list anymore. So once they were gone from the list overall. So I think we just need to be really careful about, the way we use words very often. And I say that because that relates to expectations. So it relates to expectations of investors. So when we talk about savings, now I was brought up where investing in the stock market, had nothing to do with savings. Savings is about safe. You put your money in the bank and you hope you can get it back. But we tend to, and lots of things are called banks when they're not. We are loose with our language, and I think we come to develop expectations that are not quite right. So that's just a little bugbear of mine. Someone asked about building a team. So I'm not a fund manager, so I haven't built that kind of team, but I sit on several boards of major corporates and also a major public institution. And I think a lot about how you build a board, and I don't think it's really very different, possibly. I mean, the most important thing you can do is not just look for skills. People, when they build boards, think, I want one of those, I want someone who's trained in this, I want someone who's worked in that industry, and that will help me on my board. You need some of that, but you actually need a mix of people different backgrounds and different ways of thinking. And I think that has to be true in the kind of teams that you might build in your world as well, that someone will come in and not just say, oh yeah, he or she said that, so sounds right, but actually question all the time and test. So I would just say that kind of diversity of all sorts is really important to building that kind of team. And the other thing I might say about the next generation, because Kelly talked about, things really are quite different for the next generation. 2 comments. The next generation actually gets older over time, and my sense is that there's a certain age when people are very idealistic and certain things matter, and then they change and they kind of become a little more like their parents and so forth. So there's always the next generation, but it doesn't seem to stay in the same place. We need to just keep that in mind. And the final thing is that I do think this relates to the new world that you talked about, crowdfunding and other sources of finance and so forth. It has to do, again, coming back to trust, but not the way I was talking about it before. In the olden days, we trusted our bank manager, forgive me, but that's what I'm told. You were trusted in this country, and maybe your doctor and maybe your MP or whatever. There were certain pillars of society who were trusted. And that's all basically gone away now. And people get so much information from complete and utter strangers off the internet. And we trust. And there's something in that. I don't know what more to say about it, but that is profoundly different going forward.
Fascinating, actually, that point about where the trust lies. Great, we have time for just a few more comments. So Chloe, Con up here at the front. And then the gentleman here.
A number of quite short questions here. Firstly, it's very pleasing to hear that we now have 80,000 chartered bankers reaching professional standards. But the obvious question is, how many failed? And actually, how many have been de-recognized, deregistered, expelled, or whatever the appropriate expression is? The second question, which is also equally brief, isn't it the intrinsic nature of the financial services industry, which has been corrupted into being concerned more with wealth transfer, a short-term process, rather than wealth creation, a long-term process, the root of most of our problems? And finally, if we are going to think about measurement, which has been talked about very little today, could someone please tell me the mechanism by which the long term delivers a superior return to sequences of short term? Because without knowing that mechanism, I have no idea how to go about interim measurement.
And then there's a gentleman here. Okay.
Graham Clay, retired actuary. I'm interested at the absence of any comment on matching assets to liabilities, which was part of my professional training and life. It seems to me that the definition of ruin for most institutions is inability to pay the promised liabilities in due course. That's the biggest risk, and therefore you need to concentrate on that. And that, therefore, means looking at the balance sheet, not the assets, essentially. Life office actuaries never could understand what the accountants were on about the profits for the year, let alone for the month. One anecdote, if I may. I was responsible within a multinational insurer for assets in various countries around the world, and I was told that we had to invest in the index in Singapore because they couldn't otherwise measure their investment performance. Singapore Telecoms had just been listed with, I think, about a 5% float, but it constituted 50% of the index. I told them that over my dead body, were they matching that index?
Thank you. Any last question or comment? Great. Well, panelists, we're actually spot on time at the moment for just a quick wrap-up from each one of you. And if I could, I'll probably do this one in reverse order if I could. So Kelly, some final thoughts from you on both those two comments and any closing remarks.
I'm gonna go to the closing remarks, and just to say that I think I'm really struck by the fact that the business case for long-term versus definitions and risk is something that there's huge debate on, and I that's a debate that I have off the stage every day in the work that I do, and I'm really curious, particularly with context of people having more control over their investment decisions within the context of pensions, et cetera, how we translate those big concerns into financial literacy of your average man and woman on the street, because that too drives the industry. And so I don't leave you with any comments as much as I leave you with my own question. There you go.
Although I am questioning increasingly who'll be teaching that financial
Well, that's the
literacy
thing,
if
where it
Paul's
comes
points
from.
are wrong.
Yeah.
Right, sorry. Paul?
Two questions. The first one relating to the short run. Why isn't the long run equal to the succession of short runs? The point is, the optimal strategy in the short run, if you told me you'd shoot me in 3 months if I didn't outperform, I would use momentum, I'd follow a trend.
Well, that wasn't the question, Paul. The question was, if the long run is superior, by what mechanism is it superior?
Because, well, first of all, the way you phrased your question misses the major point, which is what I said earlier, which is it's to do with the strategy you adopt, how you invest, not the term over which you hold it.
You're saying money can be made from strategies.
Well, that again is, we can't have a dialogue between us. We'll have a fight afterwards. I mean, the funny thing is that the theory of efficient markets, because it predicts efficiency and perfection, it can't actually tell you what the returns are to different strategies at a theoretical level. If you want to know the return to any strategy, you've got to look historically what the return would have been had you been adopting it. You're shaking your head, but that is a fact. The only way you can know currently the return to a strategy historically is to look at the historic return, to momentum investing. And momentum investing is always flattered because it's more data mined than value investing. In fact, collectively, value investors, people using fundamental value for the long run, pick off the 80% of investors using momentum.
Any other comments you want to make on
the trouble is, in a short presentation and question and answer section, it's almost sort of, it becomes, you can't address all the issues and all the questions like liabilities and so forth. The field of investment should be much richer and answer more questions. We should have a theory that addresses those questions.
I'll have a brief go at the liabilities, the matching assets question. So in some sense, if you can do a decent job of compounding wealth over the long term, one ought to do a better job with one's assets than merely trying to match one's liabilities. But the use of the word merely there might be offensive to some. And I mean, a lot of what we've been talking about today is the process by which one tries to gain confidence in a long-term approach to investing and compounding. My personal view is that if you settle for matching, you are compromising your long-term abilities to compound up, and that is a kind of career risk calculation which is inevitable at times, but probably leads to suboptimal results.
In answer to the specific question about how many of the initial 80,000 bankers or close to that number, who've achieved this first standard, of those who set out to try to achieve it, there was a failure rate of between 5 and 6%. And the program is that each of the banks takes those people who failed for whatever reason and works with them to help see them through. In terms of punishment or striking people off the list, that's part of the program, but it is so recent and so new that I don't have a statistic for you, but that is absolutely part of the program, that will happen. In terms of measuring assets and liabilities, I won't speak to that technically at all, but I would simply say that if you're a firm or an investment manager or a bank or whatever, and you've made a promise, and so if the promise is, give me your money and you will get this back in this period of time, we can do it, then you need to make sure you've got enough in the bank that you can do it. So it's the breaking of the promise that matters in all of this. And if you've made a promise, you need to match, or you need to almost match, or you need to match 40%, whatever it is, but you need to start with what's the promise to the customer in the first instant. You can't forget the customer. And that's really what I would, I suppose, close on. Measurement, and whether it's about performance or any other kind of measurement, becomes a very technical and a very, in a way, a mathematical matter in many respects. But then things happen out there. And again, it's this idea, don't forget the vagaries of human nature, of a world that suddenly something happens that was unexpected, that brings a different kind of impact. And I say that in particular, there's an academic at Oxford called Ian Golden, who's written a number of books, but one of the ones last year was about how certain things spread like viruses around the world. And it isn't just viruses, it's other matters as well. And you actually don't see how they're spreading and how they're coming, but we just need to be very conscious that measurement isn't perfect because it's numeric.